Hello and welcome to today's class. It's Wednesday here in the second summer session, so hopefully everyone is enjoying the session. I see a lot of you dropping off on discussion board. Try to get in there again. Remember, that's 50 points of your class participation grade at the end. If you're in it every day putting something in, you'll get off 50 points. Then it'll go down from there. So if you miss once or twice, probably not that big of a deal. But if you continually miss, some of you haven't done it at all. That would be basically a 0 on your class participation, what makes it impossible to get an A in class and pretty hard to get a B. So try to be a part of that. That's the only way we can interact here in this online world we're living in this class, to know that you're here and know that you're participating at least on some level. Thank you for all of you getting your papers in. Those papers, remember, there'll be 5 of those little mini projects, 20 points each. So again, I'll grade those fairly easily. If I feel like your grammar and your spelling is good and you paid a little attention and you put some thought and effort into it, you will get likely 18, 19, or 20 points. If you feel like it's lacking in that, it'll get less than that. Remember, 5 of those add up to 100 of your grade, and I'll post paper number 2 probably tomorrow. And we'll have a video project on that, which will be another 20 pointer next week. And again, that would be 60% altogether when you add those of our 100 points. Also, we will have a final project. I'm going to post information about that. And then we have a test next week. So remember all those things, a lot to keep in mind in this kind of a fast-paced summer environment. You're getting lucky because these we could be keeping you for an hour and a half, and these lectures are not that long. A lot because we're saying I want you to watch it over and try to absorb the information. Also, none of you are going to sit here and watch a video for 90 to 100 minutes, so we're trying to figure out some ways around that. So we'll talk about financial management. I'm going to take the financial management from the last session, drop that in here, and then we will come back and talk a little bit more about what's expected down the line. Okay? And learning about just basic aspects. This isn't an accounting class. This isn't a management or this is a management class, but not a financial management class. Talking a little bit about budgeting, learn some common types of analysis, and then some tools that you would use in financial analysis. The thing I think that most people have a problem with in management is that they are managing other people's money. And so really the best thing you can do as a manager is discover, hey, I'm going to treat this money of the business that I'm running or I'm managing the same as my own. But anyway, OPM is a great acronym test question for us that a lot of times people have problems with money because it's not their own, right? They're dealing with somebody else's money. Especially working like in a big organization like Texas Tech, state money. It's easy to spend other people's money recklessly. But we're talking about how not to do that, some things to look for in financial management. First of all, as managers, you always remain directly responsible and involved with financial matters. It's not a good answer to go, hey, I outsourced that to somebody else. I expected somebody else to do that. You should always be the one directly involved. So never delegate the financial matters. What is financial management? And that's basically just like your business, your home, anything. Properly manage your finances. Managers use financial management. It involves systematic planning, monitoring, and control. We'll talk about those different areas, starting with planning, which is developing budgets based on your history and what you're going to spend. Again, just like your job or your life. You make $2,000 a month. You say, here's my revenue. I've got a car payment. I've got a house payment. I've got insurance. I've got bills. This is our budget. Part of planning means, hey, we need new positions. This is something, again, you can associate this to your house, your home budget by saying, well, I know down the road I'm going to want to buy new patio furniture or new car, something like that. That can be like creating new positions. And you do things like establishing timelines for upgrading and replacing things like equipment, vehicles, computer systems, things of that nature that might be a little more expensive. So that's basically the basic premise of financial management, which involves proper planning. Monitoring then goes to, okay, you planned it and you've got it out. How are we doing? Managerial review of financial statements and other reports on a day-to-day or weekly or monthly basis, how you look at that. And then control means who gets control, authorizing the purchases, establishing internal policies and procedures. I know when I owned a small business, we had a procedure about who's going to pick up the checks, who's going to deposit the checks, who's going to pay the bills. That's a form of control, that you know where the money is, who's controlling the money, who's spending the money, who has access to the money, who has access to the different aspects of your business. So financial management is needed not only to maintain control, but also to meet the goals of your owners and investors, because we'll get to this in a minute, but we want to make money, right? Whatever you do, generally the bottom line is you want to be able to pay yourself, you want to be able to make money, you want to make a living out of it. So when setting financial goals, managers must consider the state of the economy, local, national. Let me give you an example here for us. So when we're selling tickets, for example, we take into account the state of the economy, and hey, the oil business is doing well, the cotton business is doing well, whatever that would be, and that helps you decide what legitimate goals are. Technology changes need to be taken into effect. Regulatory issues, again, we're monitored by the government, and audience taste and preferences, and that goes along lines with what's popular now, what's not popular now. Is what you're doing maintaining relevance? So go back and say you want to manage it by planning it, monitoring it, and controlling it. Planning is mapping it out. Monitoring is going over the information you have. Control is deciding who is spending what. And then you take into account these other things. And again, especially if you're a public corporation, you want to meet the goals of your investors. So you can establish financial goals in many different ways. You can say, hey, we're going to increase our revenue by X percent. You can say, hey, we're going to cut our costs by 10%. You can cut our costs by 5%. We're going to increase our revenue by 10%. You can cut our costs by 5%. There's all kinds of different ways you can establish that. And you can manage your success. You can gauge your success by a couple things: your profit or your loss, the margin, which means basically the amount you make over what you put into it, and then investor appreciation. You hear this all the time, that there's a lot of money, for example, in the grocery business, but the margins are very thin. They don't have a lot of area to play with on price because margins are thin. And so margin basically is the percent that you make. And then investor appreciation, if you've got some money in it in a business, the percent you're making back. So going back to implementing financial management, the manager works closely with other people in the business administering the finances of an electronic media facility. Again, we should go back to that. You should never delegate it. You should never make it someone else's responsibility. It should always be your responsibility. Obviously, the number of personnel involved depends on the size of the organization. But regardless of the size of the organization, besides your accounting functions, you have banking. You got to deal with the bank. You've got to bill your customers. You've got to collect the money. You've got to pay your staff and other personnel obligations. You have to pay your taxes. And there are things you're buying, right? You have to purchase. And so that's all part of whatever you're doing. That's all part of your day-to-day accounting functions of organization. So you control the amount of money that flows into an organization. A lot of times when you're dealing with radio, television stations, that's a lot of money. And then you have some kind of a system to keep track of all financial transactions. That's pretty basic. So obviously you can have an accounting system that tracks revenues and expenses, coordinates your inventory, provides forecasts of where you're going to be, and obviously different types of reports. So if you have, especially television and radio, you have a certain amount of inventory you can sell, you need to have some kind of system that coordinates and controls your inventory. So again, manager doesn't have to be the lead person on this. Manager doesn't have to be the one just working with it on a day-to-day basis. But the manager must be able to understand the information and how to access the information. It all starts with budgeting. That's the first step in anything. Managers need a budget in order to achieve established financial goals and objectives. Did we make budget? Budgeting is usually an annual process, and you go through it. It depends on the time of year. For us at Texas Tech, we have a fiscal year of September 1 to August 31. Some places, most electronic media places are on a calendar year. January 1st is the start of a new budget. Once it's approved by the process, you approve it. It's monitored at regular intervals. You go over weekly, you go over monthly, you go over quarterly, however is best for you. So you use different financial statements. Again, we talked about this. Business have a fiscal year. It may differ from the calendar year, and each business chooses what its fiscal year is going to be. We talked early on about middle level managers, lower level managers, high level managers. Usually the middle and lower level managers submit the budget. They say, here's the budget for my department. And then into that, you go back and you look at, again, past performance, what our revenue should be, what our expenses typically are, what equipment you need, what personnel you have, and everything else. So this is very similar to what we talked about yesterday, the principle of past performance. You determine your expenses a lot based on what your expenses have been in the past. And then, again, departments may have certain parameters when creating the budget. So my group this year, when we had to create a budget, we had to submit a budget that represented a 10% increase in revenue, a 1% decrease, a 5% decrease, and a 10% decrease, not in revenue, but in operating expenditures. So again, you can decide what those parameters are for your budget. And so really when you submit the budget, it's a report that summarizes your budget and then justifies what you're spending. So that goes into setting the goals, setting the priorities, and setting your individual budget. When you have major expenses involving equipment and things like that, that's called capital budgeting. It's a whole separate deal. Capital budgeting is long range, and you might say, hey, we want to do these things over the next 5 to 10 years. At Texas Tech, facilities are a big part of capital budgeting. We want to build these X number of facilities over the next 7 to 10 years. And again, usually capital budgeting involves expensive purchases. And capital budgeting allows management to say, hey, these things, which of the following things would be good to increase the overall value of what we're doing? So if you have several different departments, the manager compiles the budget request from each department, and then the manager looks it over and says, that's reasonable. That's not necessarily reasonable. We don't really need this. So you go through those things basically line by line. And then after that, the manager gets back with the department heads and talks about, yeah, that budget's reasonable. We're going to cut this budget for this reason. Here's the way we're going to modify it. And again, the manager prioritizes the capital expenditures from each department. So I have 5 different units report to me, and they all have big capital expenditures. And then from there, I decide which of the capital expenditures is going to be the most important for us. And then once that's all determined, once the manager determines the budget, it becomes the blueprint, comes out of planning, and then we talked about monitoring. And so then it becomes the blueprint for what you monitor. If you're going to monitor, you have to know what you're monitoring off of. And the budget, the final budget, becomes that blueprint. Obviously, you want to have some degree of flexibility, and because of our nature of our business, it needs some flexibility. And we talked about your home. Again, just like your home, usually you have something set aside because something happens. If you're in the broadcast business, you might need to fix your tower. You might need to paint something. You might have some huge expense that you didn't know about. So you have a reserve account set aside for that. And then budgets also help managers project estimates of future revenues and expenses. What's coming down the pike? What are we working on? What do we look ahead to for the next X number of years? This is also known as forecasting. And you might say, okay, I think it's legitimate. In 10 years, we're going to double our revenue. And that's called a forecast. You look ahead and you work long range on those type of things. Problem with forecasting, you don't know what the economy is going to do. You don't know what's going to happen in technology. You don't know what regulatory decisions are going to come down. You don't know what's going to be different in society. Think about this. So we showed the Pope video from 2005, and again 11 years later, and then again 5 years later. You don't know what's going to happen, and so that's why forecasting can be very difficult. There's different financial statements and reports you can use to monitor and evaluate where you are. Again, you have journals, you have ledgers, and again, this shows again the oldness of the book, that, hey, the programs can be computerized sometimes. But there are individual entries that you put into your computer program about your business, and those are called postings. And so you're posting the different financial transactions. Other journals include a cash receipts journal, cash disbursements journal, where your money's going, sales journal, and then a general journal. Ledgers usually consist of your accounts receivable, and that's who owes you money. It's your accounts receivable. It's worth something. You build $100,000 worth of advertising. You might not have that $100,000, but that is worth something to your business. It's called your accounts receivable. Accounts payable is what you owe out to different businesses. Your payroll ledger, and then your general ledger. Information from the general ledger is used for preparing things like your financial statements, your balance sheet, your income statement, and the statement of cash flow. Whenever somebody is looking at your business, evaluating your business, whether it be a banker or somebody who might want to invest in you, they want to see your balance sheet. They want to see your income statement. They want to see, what kind of money is coming in and out of your business. The balance sheet summarizes the financial condition of a firm at a particular point in time, allowing one to compare its condition at given times. Hey, you're better at this time of year than at others. Your balance sheet basically lists three things: your assets, your liabilities, and your equity. So again, balance sheet has assets, liabilities, and equity. The term balance is used to indicate that a firm's assets are equal to the total liabilities plus the owner's equity. So assets plus liabilities plus owner's equity equals term balance. Again, accounting terms, I really don't want to go that too much about it. Assets represent the value of anything owned by a firm. Your desk is an asset, your computer is an asset, your vehicles are an asset. All those things considered value of your company. Liabilities represents obligations to others or money that the firm owes. We owe out this amount of money over the next couple of years. That's a liability. And the equity is, or your net worth, is the financial interest of what the owners have in the business. We're very interested in assets and liabilities, and those would be probably your test questions. Assets represent the value of anything owned by a firm. Liabilities represent what you owe. Talking about assets, they fall into three categories. Current assets can be converted to cash quickly. They're known as liquid assets, include cash money, market accounts, securities, accounts receivables, inventory. A lot of times there are businesses that will come out and buy your accounts receivables. So let's say you have $100,000. People owe you $100,000 worth of advertising revenue. A business might say, I'll buy that from you for $60,000. You get $60,000 right then, and they own your accounts receivable, and they can make $40,000 by selling $100,000 worth of your accounts receivable. So your current assets are things that can be quickly turned into cash. And then you have fixed assets. which are land, property, equipment, and things that maybe don't translate as quickly to cash. And then you can have intangible assets such as patents, trademarks, copyrights, insurance, etc. Your license, your FCC license, is an intangible asset. There's a fixed cost to get that, but it means something to your business to have your FCC license. So it's not necessarily something you can turn around and sell, but it's something that gives your business value. Tax regulations require all companies to dispose of the value of their fixed and other assets over time through depreciation and amortization. And so, again, we're not going to talk too much about that, except for depreciation is a method used in deducting the cost of tangible assets, and amortization is for intangible assets. You've heard this all the time. Your car is depreciated. You buy a new car, it depreciates by the time you drive off the lot. There's a method to that. There's a dollar amount you can apply to that. So the other part of the balance sheet reflects the financial obligations of the organization. Those are liabilities. Current liabilities can be eliminated in 1 year or less, like you've got to pay your taxes, your payroll expenses. Then your long-term liabilities represent obligations of 1 year or more. You might have a 3-year bank note. You might have a mortgage, those type of things. So those are longer-term liabilities. And then you have the third and final component of the balance sheet, which is the owner's equity or net worth. Owner's equity, besides in the business, would also include earned income, their investment in the company, the amount of stock owned, things like that. So the income, also known as the P&L, the profit and loss statement, charts a firm's financial activities over a set of time. We just talked about that. Income statement, also known as the profit and loss statement. Great test question. Income statement, also known as a P&L statement, true or false? True. Income statement, profit and loss. The P&L differs from the balance sheet in that revenues and expenses are reported along with profit or loss. So they're both on there, which is a little different from the balance sheet. Revenue is money that flows into an organization through the sale of various products and services. Again, we talked about this before. We are a dual product market, so we generally get revenue from selling our business services to subscribers or users. And then also we generate revenue through selling advertising and selling advertising towards those people. So those are 2 ways you get revenue. Expenses are part of the operating statement that lists all relevant expenses. You have to pay for programming, what it costs to run a news department, what it costs to run your engineering department, things of that nature. So all those are listed as your expenses. What it costs to run the day-to-day part of your business. Managers use a statement of cash flow to track the money of an organization, how your money is flowing in. The statement summarizes the sources and uses of the cash in an organization and presents beginning and ending cash balances that your business has at the end of any given time. And so a statement of cash flow falls into 3 sections. Cash that flows from operating expenses, cash that flows to or from investment activities, and cash flows to or from financing activities. Those are all part of your statement of cash flow. Again, don't worry too much about this stuff. Just worry more about the terminology and some of the terms. And again, we'll go over these in the test review tomorrow. So, in addition to the balance sheet, income statement, and statement of cash flows, firms also use other financial statements to monitor financial conditions. These include statement of changes in owner's equity. So if an owner's equity changes at given times, generally there's a statement that reflects that. Then you go, you have retained earnings, a statement of your retained earnings, your statement of changes in financial position, and then statements related to specific projects. In 2002, there was something called the Sarbanes-Oxley Act, which basically imposed changes and protocols on different segments of corporate financial reporting and requires that each CEO sign off on the truth and validity of their financial statements or face criminal prosecution. So that basically isn't, it's just to make sure you're on the up and up. You're not presenting bankers or others or investors inaccurate information. I'm going to skip about ratio analysis because not something that would be important here, but there's something called a break-even analysis, and that's the amount of revenue needed to cover the total cost in the business and how many units of a product must be sold in order to make a profit. So let's say you sell hams and you have 40 hams in the freezer, and you know to break even you've got to sell 20 hams. If you sell 20 hams, you have broken even, that you've paid your bills, you're able to operate, you're able to pay for the hams and all those things. Anything over the 20 goes into your profit margin. But the break-even analysis is we need to sell this many. So television and radio stations will do that for the cost of their advertising. They'll say we have X number of commercial spots available. We need to sell this number at this amount to break even. Anything else above that, we make a profit. Costs, we talked about this a minute ago, are usually examined in two categories. Fixed costs, which is your buildings, your land, your equipment, those things that are fixed. And then you have variable costs, which is cost of labor, programming cost changes, things like that are different. They vary, so it's called variable costs. Again, depreciation, amortization, we talked about those. And the final step in financial management is reporting. And generally, you get executive summaries, which are just concise reports you can look at to say, okay, here's how we're doing. You have quarterly reports, which highlight the last quarter plus the previous quarters if you want to do that, but basically quarters done in 3-month period, and gives you a little better look at the financial stability of a firm. And then annual reports, which are basically everything from the year. So you take the whole year and you look at that. So that's part of another common report. So that's it for financial management. Again, we went over those really quickly, so don't worry necessarily if you're going, gosh, that's just too much there, and how am I supposed to remember all that? Look at the slides. I'll ask the questions that'll be fairly easy to look at as far as what we're doing, but we just want to talk about the basic things, the basic terminology that you need as a manager to go through on financial management. We're not asking you to break down ratio analysis and those things, but you just want to remember things such as break-even analysis, other terms like fixed costs versus variable costs. But we'll have all those in our review. Because this is such a boring little subject, we're not going to have a message board discussion about this today. We'll give you a break from that today on Wednesday, but tomorrow on Thursday we'll come back and we will do